this was a Mike Trout-like quarter. I mean, they crushed it on an iPhone relative to a supply chain.
For those who don't know Mike Trout, he's considered one of the best players in baseball.
Yeah, so I'll call it.
We're all playing on the same.
So I'll call it a Mike Trout, a Tom Brady-like quarter. In terms of from an iPhone perspective, you look at services better than Whisper, combined with what we saw in the supply chain. I mean, this is one in Cupertino. They print this press release off, frame it, put it in Cook's office.
Few moments later.
Doomed, I told you! Ah! Go!
All right. Today is Thursday, the 28th of April, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, but time is of the essence. So let's dive right into it. In focus tonight. The economy is free falling, and big cap technology earnings confirm that. Happy negative GDP day. Yay! The GDP went negative. The economy is collapsing and falling apart. And of course, stocks went higher, a massive rebound. But after hours, things started to sour again after we got big tech earnings from Amazon and Apple. So what's going on here? Obviously, the stock market rebounded based on oversold technicals, not because the negative GDP is good news. And the oversold technicals could last for a little while. But make no mistake about it at all, this economy is already collapsing and falling apart right before our eyes. Look at the Atlanta Fed GDP estimate, for example. It kept going lower and lower and lower. And in the last estimate, they gave us about 0.4% GDP growth in the first quarter of this year. And here's what we actually got. The GDP, US GDP, went down by 1.4% in the last quarter of this year. All of these phony estimates, false hopes, and endless pumping in the news media, on TV, that the economy is great, this is the best economy we ever had. We just have a little problem we call inflation. Oh really? This is what you call a great economy? The GDP went negative for the first time since the thing crash started in 2020. And absent of that, the only time we saw GDP down was back in 2014. And of course, the propagandists came out of the woodwork and said, oh, don't pay attention to this GDP reading. It's an outlier. It has some things about imports and exports, but besides that, the economy is great. The economy is hot. Look at consumer spending. Consumer spending went higher. But here's the catch. Consumer spending is going higher because the consumer has to chase inflation, and they're swiping those credit cards up and down, up and down, up and down, racking up debt month over month, month over month, month over month. And this will be a recipe for a disaster when the economy finally falls into a recession and people start to lose their jobs. Now they have debt all over the place, and interest rates continue to rise higher and higher and higher. The propagandists say, oh, the GDP went negative because we did not export in the last quarter of this year. Exports went down by 5.9%. Meanwhile, imports went higher by 17.7%. Folks, this nation is falling apart, not just economically, but otherwise. We're a nation that imports goods from China and all over the place, but we export nothing beside weapons, oil, and farm products. Thank you to the genius politicians and policymakers who put us in this position to begin with. This is a dying nation, and it's not just an outlier, by the way. Exports went down 5.9%, but this has been a trend for a long time. Look at, for example, the third quarter of last year. Exports also went down by 5.3%, yet we had a positive GDP of 2.3%. So this is not an excuse. This is a piece of evidence that the economy is falling apart. We will look at the estimates from the experts, the economists. Well, they told us the GDP for the first quarter of this year will be positive by 1%. And then in the second quarter, it's going to shoot up higher to 3% because of the reopening of the economy. They've been jerking off to this so-called reopening since last year, and we're still waiting for the reopening. So you can take all of this and flush it down the toilet. They said consumer spending will be up over 3% the first quarter of this year. Not even close. So take this. This is trash. Throw it away. From now on, the assumption is the GDP will continue to go down. And consumer spending, if it goes higher because the consumer has no other choice but to continue to swipe those credit cards to chase this inflation. When you say the economy and the GDP is going to rebound and move higher by the second quarter of this year because of the reopening of the economy, bullshit. What do you say about this? The U.S. Dallas Fed Manufacturing Business Index gave us a reading of 1.1% in April. Now you might ask, what's wrong with that? Well, the estimate was for 5. And the previous reading was 8.7. The economy is falling apart, folks, and inflation is surging out of control. We got the reading for home prices, for example. In Phoenix, prices are up by almost 33%. In Florida, Tampa, 32.6%. Miami, 29.7%. And it goes on and on and on. And rents are even more stunning. The inflation in rents is killing the average family in this country. The poor, the middle class, not to mention gasoline prices, grocery store prices, food prices, utilities prices. Everything is moving higher, and it is choking the poor and the middle class in this country. We got a survey from the NABE that shows wage inflation continues to move higher with no stop in sight at all. A record 70% of U.S. companies showed increases in wages, wage inflation. Now you might say this is good news, or wages are going higher. When you factor in inflation, everybody's down. Matter of fact, wages for the average American went down by a minimum of 3% because when you factor in inflation, and this is the Fugazi number by the Kitchen, the Bureau of Labor Statistics, the cooked number of 8.5%, you factor that in, the majority of workers are down. Their wages went down. And when you factor in the reality that inflation is actually double digits right now, perhaps at 20%, the picture gets even more dire to the point where it doesn't make sense to work anymore because whatever wage you're getting, you're actually losing money. And look at this. Real disposable income is at all-time low. When you factor in inflation, this is the lowest standard of living that Americans had to endure in history. The purchasing power of the average American is collapsing. This is a great economy? Give me a break. Look at personal incomes, for example. They're going negative once again. This is the beginning of the end of this economy. Thank you to the lunacy of the Federal Reserve and this insane, reckless administration. And they say, oh, blame it on the unemployment rate. When the unemployment rate goes down, inflation goes higher, as the Phillips curve says. Well, Dr. Friedman debunked the Phillips curve over 50 years ago. And as you can see, we had low unemployment rates before, yet we did not have inflation. Inflation only occurred because the Fed initiated the cocaine operation of unleashing the largest wave of liquidity in human history. Why? To prop up the stock and real estate markets to save the assets of the rich. That was the entire purpose behind the cocaine operation. And now all of us are paying the price. And the Fed remains way behind the curve. The moment those two lines crossed, the Fed should have acted right away by hiking interest rates higher and tightening the monetary policy to control this inflation. Inflation right now is reaching 10%, and this is the cooked number, by the way. The real number is closer to 20%. When Americans are asked, what is the biggest source of financial stress that you have to face right now? 27% said managing living expenses due to inflation. 19% say saving and investing / planning for the future. 13% say managing debt. 7% say income or job security. 5% say improving my credit score. 7% say other. And then we have a stunning 23% who say none of the above. Let me fix this one for you. Here it is. 23% say my spouse. Anyways, inflation is changing consumer habits and consumer behavior when it comes to spending. And this is an alarming sign for this economy, because what is going to support this GDP to go higher, to rebound higher, as the experts suggest, if the consumer is not going to spend in the economy because they're spending more in rents, gasoline, food, utilities? They're not going to have disposable income to spend in the economy. They're not going to be able to travel, eat at restaurants. So we will see the collapse of this economy, starting with, unfortunately, small businesses, restaurants. They're going to be wiped out entirely. Roughly 70% of Americans are changing their summer vacation plans due to costs. The inflation impact on travel is absolutely stunning. 25% say they're going to take fewer trips. 25% also say they're going to travel shorter distances. 23% say they will engage in cheaper activities. Meanwhile, 22% say they will use less expensive accommodations. 19% are going to travel for fewer days, and 16% will choose driving instead of flying. All of these changing in consumption habits will impact the economy negatively. And even renowned economist Mohamed El-Arian says and warns of a full-scale stagflation, just like we saw back in the 1970s. And I say, Mohammed, we're already in stagflation right now. The next step is a recession, and after that, a depression if the lunacy continues. Matter of fact, Douchebag is now warning that the Fed will plunge the United States into a major recession by hiking rates above 5%. Now, the Fed zombies say we're not going to raise interest rates above 5%. It's going to be 2.5%. That's the neutral rate. And I say good luck with that. You think 2.5% will tackle this inflation? Think again. At a minimum, it's going to be 5%. And now Douchebag says if they indeed go there, the economy will dip into a recession. Look no further than the condom indicator. All of a sudden, we're running out of condoms. What does that mean? The government is preparing to screw you. On the bright side, at least they're using condoms. Hopefully, they'll use some lube too. But look at this, for example. Joe Biden came out today and announced that he's asking Congress for another $33 billion in more aid to Ukraine. Not to Missouri, not to Illinois, not to Iowa, to Ukraine. These lunatics are fighting this proxy war with Russia, and by the end of the year, if the war continues, as it appears to be, we're going to spend over $100 billion into Ukraine. For what? What is the point here? What is the exit strategy from this lunacy that could get us, by the way, into World War III, if not a nuclear war? Meanwhile, we have veterans in this country homeless in the streets. We have the population struggling to pay for grocery bills, to pay at the gasoline pump, to pay for utilities, to pay the rent as rents continue to surge out of whack. The American dream is dead. The majority of millennials cannot afford a home because home prices are surging out of whack. Meanwhile, wages are stagnating. But yet the administration has the audacity to abuse taxpayer money and spend billions and billions of dollars on these foreign adventures with no exit plan, with no clarity of what the end goal is. And the impact, of course, on the stock market is becoming more evident by the day. Remember, a few videos ago, we talked about former Fed president from New York, Bill Dudley, who said the stock market cannot go higher because to tighten financial conditions, the stock market has to crash. It has to go down big. We have to see more unemployment because if you want to tackle this inflation, you have to reduce the demand in the economy. To do that at this point, you have to induce more unemployment and you have to crash the stock market because when that happens, the wealth impact diminishes and the consumer becomes more conservative in their spending habits. And this is exactly what we're seeing right now. The stock market is falling apart, and it's going to continue to fall apart because this is the path that we're in right now. Tightening of the monetary policy, undoing the insane liquidity wave. On top of that, we have an economy that is already stagnating, and we have insane inflation combined with excessive taxation, a recipe for disaster. The volatility in the stock market is surging. We've never seen such consistent volatility for this long before. The market has been going up and down, but mostly down in wild ways, wild swings intraday. We're talking about 3 to 4% within a day. We've never seen these kind of swings before, except in bear markets. And this is indeed a bear market. Matter of fact, the bearish sentiment in the stock market has surged to its highest level since the great financial crisis, as investors grapple with rising interest rates. Look at the bearish reading. This is from the American Investor Survey. We're now reading at 59.4% net bearish, the highest reading in a year. No wonder why the stock market is falling apart. We have more tragedies in the stock market to come. To illustrate, look at the chart. In orange, the S&P 500. In red, net inflows in the stock market. And as you can see, net inflows is a leading indicator for the stock market. It is a catalyst for the stock market to move higher or lower. For example, when the stock market crashed back in 2020, during the Thing crash, we saw net inflows in the stock market, even though the index, the S&P 500, was falling apart. This was a leading indicator to buy the dip because equities will move higher again. What we're seeing right now is quite different. We're seeing net outflows out of the stock market. We are just getting started here. As the net outflows continue, the stock market will follow through. And even the godfather of liquidity from Citibank says the stock market sell-off still has another 20% to go. And this is his conservative estimate. But rest assured, we still have the propagandists, the pumpers, the likes of JP Morgan's Marko Kokolanovic, and here it is from FundStart's Tam Lee. Tam Lee says mega cap FANG stocks are acting like death and entering value territory amid broad sell-off. So apparently the stocks that are trading at insane valuations, these big cap stocks, are now value according to Tom Lee. I think when you see Netflix down 30% in a single day, Amazon after hours right now down almost 10%, I think the market is saying there is no value here. Speaking of earnings, let's talk about them. Today we got McDonald's, Caterpillar, Hershey's, Amazon, Roku, Apple, Twitter, and Intel, among many other names. And the theme is clear so far. Companies that are producing good earnings are doing so due to the pricing power, due to the inflationary power. They're increasing prices higher and higher and higher. The rest of the companies are absolutely getting slaughtered. Case in point, look at Unilever, for example. They beat the forecast, and the reason is they moved prices higher, and they will continue to move these prices higher to offset energy costs. Another name that is not in the list, but it is a leading indicator for the stock market, is Robinhood. We saw accounts surging higher during the heat of the bubble back in 2020 and 2021. The meme stock mania, for example. Now we're seeing quite the opposite. Monthly active users in Robinhood went down by 10%. We covered the news that Robinhood is laying off over 9% of its full-time employees. And of course, as we predicted before, all of these Robinhoodians who've been gambling on meme stocks and garbage stocks with no care at all to the valuations have now become bag holders working at McDonald's. Speaking of McDonald's, let's cover that one. And the good news is wages in McDonald's are moving higher. This is not a good report from Mickey D's because revenues went higher year over year by 11%. On the other hand, expenses went higher by 18%, exceeding the growth rate of revenues. And of course, a huge component of these expenses is salaries. That expense alone went higher by 22% year over year. And therefore, the net income for the company, the bottom line, went down by 28% year over year. Unbelievable. If McDonald's cannot cope with this inflation, who will? But the bright light in McDonald's earnings is the following, and perhaps it explains why the stock moved higher today. When we talk about the sales, in the United States, sales are slowing down dramatically. Last year, for the same quarter, sales were higher by 13.6% in the United States. This time around, this year, sales grew higher by only 3.5%. A massive slowdown in growth. Yet on the other hand, the growth in overseas markets went higher in a stunning fashion. It was 20.4% for international operated markets, meaning McDonald's operated by the company, and then the franchises went higher by 14.7%. And of course, they're attributing all of this to increased demand and sales in France and the United Kingdom. Next, let's talk about Caterpillar. This is an important indicator for the global economy. Let's look at sales and revenues for the different segments of this company and across different regions. In North America, the construction industries, those sales went higher by 28%. In Latin America, they went higher by a stunning 60%. And we continue to see this theme over and over and over again, the strength in Latin America and the weakness in Asia. In Europe, Middle East, and Africa, sales went higher for construction by 18%. On the other hand, here it is, Asia Pacific down 21%. All in all, sales for construction industries went higher by 12%. For resource industries, those sales in North America went higher by 55%. They went down in Latin America by 1%, yet they went higher in Europe, Middle East, and Africa by 25%, and they also went higher in Asia Pacific by 33%. All in all, they went higher for the company by 30%. But again, the crown jewel of this company is construction industries. Yet they have another minor segment called energy and transportation. The sales for that one went higher by 9% in North America. It went higher by a stunning 21% in Latin America, and it went higher by 8% in Europe, Middle East, and Africa, and it went higher again by 14% in Asia Pacific. All in all, it was up 12% for the company year over year. Now, the revenues increased higher for Caterpillar year over year. And look at this. Unlike Alcoa, for example, or other companies that we covered throughout this program, the volumes, the sales volumes went higher. So this is positive for the company. And of course, pricing, the pricing power, increasing prices by Caterpillar was also a factor in pushing revenues higher year over year. Yet the currency impact remains a sticky negative factor in all earnings, not just this one. The strength in the US dollar is eating away corporate margins. In this case, it did not have a major negative impact, that is, because we've seen volumes moving higher along with the pricing power. But here's the problem. When we talk about profits, the bottom line, we're seeing problems for Caterpillar, and perhaps it explains why the stock went down today. Yes, the company experienced positive increase in their profits year over year, but not by a lot, because while volumes went higher, and the impact of prices was extremely critical for the company to have positive profits, otherwise they would have went down. So the pricing power by Caterpillar is extremely critical. But here's the problem. Manufacturing costs, the input costs that the company has to endure, these costs are moving significantly higher and in a rapid fashion to the point where the company cannot keep up with these increases and moving their prices accordingly. And therefore profits were stagnating year over year. So this is a major problem. Once again, inflation is killing margins in corporate America, and this is the case in point. Next, we have Hershey's, and this is a different case entirely. This was the best report that we got so far, and of course, yours truly, the guy you're listening to right now, recommended, at least by suggesting that I'm buying Hershey's during last year. Take a listen. What about the ticker HSY for Hershey's? This is a weekly chart, of course. It has been in consolidation for a while, but it is moving higher, breaking the consolidation range to the upside. Is this bullish or bearish? The answer is it is bullish. On top of that, it is a consumer staple giant with the pricing power. This is exactly the kind of names you want to be in right now. And think about it. Cocoa prices did not move higher by a lot, and therefore Hershey's margins are still good. They're not contracting. But Hershey's can take advantage of this inflation by saying, you know what, we're going to jack prices higher too, because inflation, and that will expand their margins even higher. And therefore, I'm bullish on this stock, and I bought call options with the intentions of exercising these options and own the stock next year. Here it is, the update. Since then, the stock went higher by almost 25%. Unbelievable move for this stock amidst a bear market. We have stocks crashing 60, 70, 80%. On the other hand, we have a bull market in Hershey's. The stock gained over 25% since I bought it. Here's the explanation. We look at the income sheet. Net sales went higher by 16.12% year over year. On the other hand, the cost of sales went higher by 14% year over year, and expenses went higher by 6% year over year. The difference here is the growth rate in net sales is exceeding the growth rate in the cost of sales and expenses, and therefore the net income went higher rapidly in a stunning fashion. It was up 34.42% year over year. We look at the different categories for Hershey's. North America confectionery went higher by 11.7% year over year. Meanwhile, the sales for North America salty snacks went higher by a stunning 86.2%, and the international segment went higher by 17.9%. This was a pristine report. I'm sticking with the stock. Next, we have Amazon. Let's talk about that one. What a disaster Amazon's earnings were. The net sales went higher by 7.3% year over year. On the other hand, expenses went higher by 13.6% year over year. Now, unlike Hershey's, the growth rate in expenses is moving faster and higher than the growth rate in net sales, and therefore the bottom line for the company, the net income, was negative. The company lost last quarter $3.8 billion. And the growth rate for the different segments of the company, North America sales, last year the growth rate was 40%. Now the growth rate slowed down dramatically to only 8%. Are you starting to see what's going on in this economy? A massive slowdown, and the Fed is about to tighten. We have a double whammy that will crash this economy and push us into a recession, if not a depression. The international segment, the growth rate last year was 60%. This time around this year was negative 6%. The only bright light in Amazon's earnings was the growth rate in AWS, the cloud segment. It was higher by 37%, exceeding the rate last year of 32%. Of course, the cash flow for the company also went negative, down a stunning 171% year over year. Unbelievable. And of course, Amazon took a massive hit in their Revlon investment. They lost $7.6 billion. Why? Because Revlon stock is in the trash right now. Next, let's talk about Apple, the most important earnings that we got today. The headline reads, Apple posts big beat, a 9% revenue pop, authorizes another $90 billion in share buybacks. This is the racket of share buybacks. This has to stop, folks. The only reason behind spending almost $90 billion last year in share buybacks, and now another $90 billion is to prop up the stock, to prevent the collapse, to allow the executives to get out richer when they dump their stocks. But it is a waste of money. When the stock finally flushes down, and it will, the company will realize that it flushed almost a minimum of $180 billion down the toilet. That $180 billion at a minimum could have been spent on R&D to give this country the edge over China. It could have spent in building factories in this country, expanding the company's operations, hiring new employees. But no, they're wasting billions of dollars in share buybacks. This has to stop. But let's dig into the details and see whether clown Don Ivis is right or wrong when he says this is the super thackle for Apple, Cupertino. It's a super thackle Cupertino. Let's see if that's right or wrong. Well, the growth in net sales went higher by 8.6% year over year. On the other hand, the growth rate in the cost of goods sales went higher by 6.2%. So far, so good. The growth rate in net sales is exceeding the growth rate in the cost of goods sales. Here's the problem. The growth rate year over year in expenses went higher by 19%. This is an alarming sign that the company sooner or later will see negative growth rate in net income. But for now, the bottom line, net income went higher by 5.84%. So for now, this is okay. This is not a bad report, but they better watch out for these expenses. If they continue to spend like a drunken sailor, sooner or later, the growth in net income will go down and the stock will crash. But it is a leading indicator that the best is behind us. The company is facing major inflationary pressures. Now, when we look at the net sales, by segment, in the Americas, net sales went higher by 19.16% year over year. In the EU, it went higher by 4.6% year over year. And here it is, the most important segment, China. Everybody was concerned about China, but this is a relief for the company and the investors of Apple for now, because the growth rate in China went higher by 3.46% year over year. On the other hand, the growth rate in Japan was negative, pretty much at the flat line, down by 0.23%. In the segment of the rest of Asia Pacific, this was the only concerning segment. Sales were down by 6.65% year over year. We'll look at the net sales by category. iPhones went higher by 5.49%. Mac went higher by a stunning 14.64% year over year. Here's the only negative one. iPads went down by 2.06% year over year. The wearables went higher by 12.38% year over year. Lastly, the services revenue, also known as the racketeering operation by the iMob, they have to intimidate all of these app developers. Pay us the rent. 30%. You gotta pay the rent. Otherwise, we crack your kneecaps. We ban you from the store. So it is no wonder why this segment went higher by a stunning 17.27% year over year. So what is the take all in all from Apple's earnings here? We have few concerning signals for now. The growth in expenses, the stagnation in Japan, in Asia Pacific, and the iPad segment. But besides that, this was, I would say, a B kind of report. It's not bad at all. It is okay for now. And lastly, let's look at Intel. What's going on here? The headline reads, Intel stock falls following data center miss. Light outlook. What's going on? The revenues year over year were down 7%. Expenses were up 23%, a recipe for a disaster. Your revenues are down 7%. Your expenses are up by 23% year over year. But the net income went higher by 141%, and this is due to a one-time charge-off, so we're not going to make a big deal out of it. But here's the important take. When we look at the key business units of this company, the revenue growth, the most important unit, the CCG Client Computing Group, went down by 13% year over year. On the other hand, Data Center went higher by 22%. Network and Edge Group went higher by 23%. The Accelerated Computer System and Graphics went higher by 21% year over year. And then we have the Mobile Eye, that went higher by 5%. And then the Intel Foundry Services went higher by a stunning 175% year over year. So it is not a bad report all in all. I would say it's a B plus kind of report, maybe B. But the most important thing here is the outlook. We got warnings from Apple about China, and then we got another warning, a weak guidance by Intel that things will slow down from this point on. So the take all in all is, we're seeing certain companies falling apart, the likes of Amazon, a bad sign for the economy. We're seeing other companies doing fine for now, but they're also warning about what's about to come. These are Apple and let's say Intel. And then we have companies that are holding on for now, flexing the muscles of their inflationary and pricing power. And in this case, it is Hershey's. But the all in all theme, things are slowing down dramatically. And it is a cause for concern for this economy in the stock market. Folks, it has been a hectic week for me at work, so I'm recording this a little late. I'm going to have to skip certain segments of this program because I don't want to release this video by midnight. So we're going to move on right away to the charts analysis, and we start with SPY, the S&P 500, an hourly chart. What's going on here? We got the rebound that we've been waiting for that got us all the way to 430. It appears for now that we have a reverse head and shoulder formation, which should be a solid bottom for now at least. It is not the cleanest formation of a head and shoulder pattern, but it's good enough. Meaning, if the SPY pulls back tomorrow, let's say after Apple's and Amazon's earnings, or we go down to 422, for example, the assumption is we're not going to violate 416 as support. If that happens, run for the hills. We have another ugly week coming next week. I doubt that will happen. I see more short covering happening, specifically if the market decides to look at the glass half full in Apple's earnings. But if the market decides to concentrate on the glass half empty, which is Amazon's earnings, then we're going down. But the assumption for now is we should stop at 416 in the worst case scenario in tomorrow's session. And here is the daily chart for the continuous contract of the SPY, the S&P 500. The good news is the volume is receding. It's going down, meaning we have reached the selling climax. This is good news for the bulls. Likewise, the momentum indicators, they're still negative, but they're holding ground, and it appears they want to move higher. Another piece of good news. Even though after hours, the indices went down on the heels of the negative earnings from Amazon, and you could say Apple too, but the chart continues to keep 4,232 as support, at least at the time of the recording of this video. If that support is violated, then we got a problem. But for now, so far so good. Believe it or not, even though we have ugly earnings and reactions after hours, the participation in the options market today alone, the volumes went higher. Some call options buying, we're seeing the revival of buying call options combined with short covering that actually could take us higher in tomorrow's session. It's not going to be easy, but so long as the chart keeps 4,232, it is possible. What about a daily chart for the SPX, the cash index? What's going on here? We got another rebound of 4,200. This is important. Why? When we talk about the Wyckoff pattern, if the chart closes above 4,200 by the end of the week, meaning by tomorrow, the assumption is it's going to run a retest all the way up to 4,400, and then we'll take it from there. If there is a move above 4,400, then we go to 4,500 and then 4,600 and then go down in a retest of 4,500. We discussed that in details in Sunday's video. But if there is a failure at 4,400, then we're going to go down big. We're going to go down to the secondary test at 4,114.65. If that's cracked, then we're going down another 12% or so. This is at least according to the Wyckoff pattern. Next, let's talk about the Qs and hourly chart for the NASDAQ. What's going on here? We got the rebound. It got us all the way above the target that I talked about in last night's video, 327.66. Matter of fact, the chart almost closed the gap, but it stagnated from that point on. Could we have a pullback based on Amazon's earnings, for example, down over 9% after hours? The NASDAQ will not be able to make it if Amazon opens down 9%. It needs to recover. Maybe we will see a down opening and then we will see a recovery and some dip buying combined with short covering. If that is the case, then what if this is another ABC pattern? We got the A leg, which is both the A and the C of the previous pattern, but it is the A now, and then we go down in a B leg formation, and then we see a rebound, more buying, which forms the C leg, and that will take us all the way back to 334 as resistance. Of course, the line in the sand is 316.5. If that is broken, abandon, we're going to go down big. And here's the daily chart for the continuous contract for the NASDAQ. We have a drop after hours, as anticipated, of course. The good news for the bulls is the volume is moving down slightly. The momentum indicators appear to be in an attempt to find the bottom and move higher from this point on. Another piece of good news is if the chart keeps 13,300 intact as support by the end of the week. But most importantly, the trend line in yellow, because a closing below 13,300 and below the yellow trend line would be ominous, indicating that we have more losses in the upcoming week. And here's the hourly chart for the IWM, the Russell 2000. What's going on here? The most important line is 188. For now, the bulls made the deed of moving above 188, but you got to secure that. How do you secure 188 and not risk a flush down next week? The answer is by recapturing 191.5 as support. Can the bulls do that by the end of tomorrow's session? We'll see. If that is the case, then we could see the IWM moving higher next week. If not, it's going to keep us on edge. The support would be 188. The resistance would be 191.5. But if we have a weekly closing below 188, run for the hills. Moving on to the Dixie, the dollar index, and instead of looking at daily chart, let's look at the weekly chart because we have the target that I discussed yesterday, 103. This was the high in 2020. We're already above that. Now we're looking at the highs of 2017, which is around 103.8. The assumption here is this is the last hurrah rally for the dollar, meaning it is impulsive, lots of short covering, lots of panic buying, and of course it's happening because the devaluation of the yen and other currencies, the British pound is collapsing, the euro is collapsing. We got inflation readings from Germany in the morning. That did not help, and it pushed the dollar even higher. But if the dollar stops here, and it tops at this point, and we see a reliable signal that this is the top for now, keyword for now, then this would be a relief for gold investors. Look at gold, for example. Gold is a leading indicator for the dollar, and gold did not give up 1,895 as support. Matter of fact, it is reclimbing that number, indicating that perhaps gold sees the top in the US dollar coming. I know we discussed before that if the dollar moves above 103 and gold loses 1,895 as support, perhaps you want to book profits here. But I'm being patient, and I tweeted about that today. I'm being patient because I'm sensing that there is a top coming in the dollar and gold will move higher again. I could be wrong. This is the risk, of course, and you can manage that risk easily by booking profits right now. I just choose not to do so. I don't want to pay taxes right now on the gold miner stocks that I have. So I'm keeping my positioning and I'm crossing my fingers that what I'm seeing right now is an indicator that the dollar is about to top at some point very soon and gold will move higher above 1,895 and perhaps reclaim 1,925 as support once again. Of course, gold gyrated back and forth in today's session after the GDP reading. It went down, it went up, but again, the dollar is not going to make a high conviction move up or down unless the dollar makes that move before. And here's the 4 hours chart for the UK oil, Brent, crude. The bull flag appears to be playing out. It got us above 105.84. Now we have some soft resistance at around 107. Then we have another soft resistance at around 114. If the chart passes both, we're going to hit hard resistance at around 118. And that would be the profit target. Now you have to assess the risk. Do you buy now or after the chart passes 107 as soft resistance, then support, or after it passes 114 as soft resistance? That's up to you. This is the name of the game. We are in the business of risk taking after all. Assess the risk and make your decisions accordingly. Here's the chart of the 10-year yield, the daily chart. It appears, looking at the RSI and MACD indicator, that we have at least consolidation for now. We're not going to say top because to form a top, you need a reversal candle and you need a confirmation. We have neither right now, but what if this is a consolidation at least? This would be good enough for the stock market to have the green light that yields are not going to move impulsively higher, at least until the Fed's meeting. That could open a pathway for equities to rally. And here's the weekly chart for the TLT. No update here, but we're looking at 125.12, which happens to be the gap. Can the chart make it over there by the end of the week, meaning by tomorrow's session? It's a long shot, but what the TLT bugs should be looking out for is at least, at a minimum, keeping the lows intact. The VIX 4 hours chart, what's going on here? The VIX remains strong, lots of put options buying, but the MACD indicator is giving us a signal that the rapid move, the impulsive move higher, already ended, meaning the best case scenario right now for the VIX is stagnating, consolidating for a little while, and then gathering the energy to move higher again. That would be the bullish outlook for the VIX. But if the MACD indicator is right, along with the negative divergence on the RSI, then we should see a down day in the VIX tomorrow. But this will not be easy right off the gate because we have negative earnings from Amazon and Apple, Intel. We're seeing a negative reaction in the indices after hours. So what if this happens? What if the VIX pops higher again in the morning and the equities market opens down, gapping down? We see the VIX running a retest at around the highs of 33.5. Then it gets rejected and we see dip buying in the equities market. We see short covering in the SPY and we see the VIX moving down from that point on. We have a double bottom. That would be a more reliable call than calling the top in this move in the VIX right now. And by the way, whether we look at the VIX or the VSTOXX index or the Bank of America Volatility Index, all of them appear to be running out of gas right now, suggesting that the VIX could be next and we could see a rebound in the equities market all the way till Fed's day. It all depends on how the market is going to read earnings. Is it going to go with Apple's earnings? Is it going to go with Amazon's earnings? And even if it goes with Apple's earnings, we still have landmines in Apple's earnings. The increase in expenses, the slowdown in iPads, the slowdown in Asia Pacific and Japan. Not a big deal in my opinion. I think the dip could be bought in Apple tomorrow. If that happens, the VIX will move down. Apple is more important than Amazon. We'll talk about Apple in a minute, but here's the VXN before we do that. 4 hours chart. Unlike the VIX, we're not seeing confirmation by the MACD that this is the top indeed. But the VXN did not move higher today. It continues to keep 40 as the top for now. We're seeing negative divergence, not a big one on the RSI, indicating that we could see the downward shift continuing. We could see finally a confirmation by the MACD indicator by showing red impressions on the histogram that this is indeed the top for now for the VXN. That would give us the green light to buy the Qs. Absent of that, if the VXN moves higher tomorrow, the assumption it could, because Apple is down, Amazon is down after hours, it could run another retest at 40. The question is it going to pass 40 or is it going to form another double top and move down from that point on? If that happens and you get a solid rejection, then you're going to buy the dip in the Qs. So watch out for these two charts in the morning, the VIX and the VXN. And here it is, Apple, a daily chart. What's going on here? We got the rebound, a gap higher. Now, at the time of the recording of this video, the chart is trading at around 160 after hours. So could we see the chart going down even further, all the way to close the gap at around 157 and then rebound from that point on? It all depends on the sentiment and the psychology. If the market remains negative when it comes to the sentiment, then 157 is not going to hold. If that doesn't hold, you know it's going to be bad for Apple. If it is bad for Apple, it is bad for the Qs and the SPY. On the other hand, if we have a rebound, dip buying, short covering, it doesn't matter what it is, you know right away you're going to buy the dip in the SPY and the Qs. And here it is, Tesla, the Stagflation hourly chart. What's going on here? We talked about the potential of a double bottom that could take us all the way to 918. We got a spike in the morning, not quite to 918. And then we got another massive flush down in Tesla. It got us all the way down to the support of 825.25. Now the assumption is if the negativity resumes, what if this is an ABC pattern that could take us down all the way to the next support at around 802.41. But hold your horses, we got news after the bell. Let's talk about this. The headline reads, Tesla stock is dropping like a stone. There is no reason. We've been talking about the mystery of Tesla stock. Is it being targeted by enemies? New founded enemies of Elon Musk after his acquisition of Twitter, for example? That's the reason. Another reason is Elon Musk is committing a lot of risk in buying Twitter and holding Tesla shares as collateral. And now we got the news, the breaking news, that Elon Musk dumped over $4 billion worth of Tesla stock. So it was the oligarch himself dumping his own stock once again to fund the acquisition of Twitter. He says no more dumping from this point on. So will that be a green light to buy the dip in Tesla? We'll see. If not, then the ABC pattern will play out. And of course, Elon is all over the place. Now he's joking about buying Coca-Cola and reintroduce cocaine in the beverage. So the guy, sometimes you question whether he is joking or whether he's absolutely out of his mind. And now he's being targeted, by the way. He has to take that seriously. The ACLU is now saying that Elon Musk is the one who paid the donation on behalf of Amber Heard. And we're getting more of that dirty laundry exposed to the public. That perhaps Elon Musk dated Amber Heard based on an arrangement. They're gonna hit Elon, no doubt about it. He made new enemies, and they will air his dirty laundry, no doubt about it. And here it is, waking up from the coma, the FTC this time around, investigating Elon Musk's acquisition of Twitter. Not the most recent one, but when he bought shares, the initial buying of the shares, I believe back in January. So the pitchforks are coming out for Elon, which makes buying Tesla stock right now extremely risky. Between the dumping he says he's done right now, but who's to say he's not going to dump even more? Watch out here. And of course, another mysterious development right now is the fact that Twitter is trading at a discount of the buyout price. As if the shareholders and the market is saying Elon is not going to follow through. He's going to dump the Twitter deal. He's going to pay the fine, the $1 billion, and move on. But his tweet and disclosure after hours that he sold Tesla stock tells us that he is indeed serious about the deal. So could we see a move higher in Twitter stock tomorrow? This is the assumption, if the market believes Elon Musk. Next, tulips, BTC. What's going on here? Let's do something something different because the daily chart doesn't offer any update whatsoever. Let's do the hourly chart. Is what we're seeing right now at the time of the recording of this video a bull flag formation, and can it take us all the way to 42,000 as resistance, and then we take it from there? This is what I'm waiting for. And wait a second here before we move on. Here's an update. Scratch that. The bull flag is dead already. So there goes my tulip analysis. Let's move on to AMC, see if we can find something different there. Here's an update of the 15 minutes chart that we covered in yesterday's video. It did not make it above the sloping line of resistance. The chart went down dramatically, only to recover, and it finally made it above the sloping line, be it a little late. What does that mean? It made it at a lower price, and now the resistance target, assuming that AMC keeps the sloping line of resistance now as support, the target moves down to 16.10. If the chart makes it above that, then we're looking at 17.09. Absent of that, if AMC flushes down again, you know we're going down to 14.24. and then down to the gutter. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Busy, busy, busy. We have the employment cost index, and then we have core PCE, the Fed's favorite inflation measure, and then we have nominal income, nominal consumer spending, real disposable income, real consumer spending, in addition to the Chicago PMI, and on top of that we have the University of Michigan Consumer Sentiment Index. This will be the final reading for the month. A lot of action here. We also have the earnings calendar. Will be busy. We got Chevron, Exxon, Honeywell, and AbbVie. Folks, we have a lot of action coming. Grab the popcorn, buckle up your seatbelts, but this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend. Take it easy.